the markets. Now, we've got a number of questions on the market. So we're going to start big. We're going to drill in slightly further. So Andrew says, thank you for all your work. 2 questions about asset prices and debt. I understand in an inflationary environment, shorting the fiat currency debt makes sense while the inflation rate is greater than the interest rate to service the debt. But what happens, one, to asset prices and debt in a deflationary environment? By deflationary, do we just mean CPI basket, or are we talking asset prices too? Number 2, to debt denominated in an old fiat currency when it is replaced by a new currency. Brian? Sorry, Nick, go for it.
That's okay. That's a pretty tough question, I have to say, because most of the time we positioned our investments in terms of for inflation. In a deflationary scenario, it means the purchasing power of the dollar relative to all other assets becomes stronger. That is why we're seeing prices actually fall. If you look at the first chart I've got here, you'll see that I've got the federal funds rate and inflation expectations. And we are heading towards potentially a deflationary stage of the markets as the interest rates, despite the Federal Reserve raising rates quite slow relative to what they should have, they're behind the curve, they're doing it quite aggressively amidst a very challenging economic conditions. And that's why inflation expectations are falling and deflation, that's why we're watching prices fall, because the relative attractiveness of owning the US dollar or a local currency, because all central banks are raising interest rates in tandem. It's not in tandem, they're actually in coordination with each other. Literally everything is falling. Now, when that happens, cash is probably a preferred place to take refuge because it's earning more returns relative to the other assets. But at the same time, as Nick already talked about, because the Federal Reserve and the central banks have raised interest rates late and they're doing it too fast, amidst challenging conditions with the oil price being so high, consumer and business confidence have fallen through the floor. The fact that our filling up at the pumps, it's almost 80-90% more expensive than same time last year or same time even 2 years ago. People are traveling less. Food's more expensive, so you have less left in your pocket. Now, that's going to affect what you're going to do with your investment portfolio. You're going to have to perhaps sell some of your assets in order to pay some of the bills because perhaps some people lost their job or they're nearing retirement and they need to actually fund their living. In that case, the market's going to fall along with it. Now, what happens with debt-denominated assets, as in what happens with bonds and mortgages, etc., they become more expensive to finance because the interest that they have to pay is higher. And what are people funding? What are people borrowing for? They're borrowing to buy a house. They're borrowing to run a business. So you can see that there's a chain reaction. And you could almost call it a perfect storm right now. And in this case, how do you protect yourself? As I said before, one way is to take short positions, as in you buy an ETF of the index, taking a short position on the index. So when the index falls, your the value of that ETF actually rises. But these are, of course, short-term positions that you should take. Because from the indicators that we're seeing with the economic indicators, we could well see that the Federal Reserve and the central banks pause on raising rates as early as September because they know that the market is now, they've hit the brakes and the car is actually coming to a very abrupt halt. Mm-hmm. And if they go too far, as Nick pointed out, they could implode the economy. And what imploding the economy means is that instead of people going back to cash, people abandon cash and buy out real assets and turn cash into something which is worthless. Because if the central bank's product is cash, and if you don't believe in that product, you won't buy it. And when you don't buy that cash, you don't hold that cash, the value of that relative to other assets go up. And that's how hyperinflation can occur. Can hyperinflation occur at this stage? I think the chances of it is very low. But as Nico said also, we cannot underestimate what could happen given the incompetence on one end and potentially a bit of malintent, because it seems like these people, they can't not have seen this coming, and they just basically seem to ignore it every step of the way until it's too late.
What do you say, Nick? I can see you itching to say something.
Yeah, well, Germany had complete currency resets twice after each of the world wars. So to answer the second part of Andrew's question, what happens to debt denominated in the old fiat currency? Well, it depends on the terms of the currency conversion. So one of the big winners back then were the industrialists and the farmers, because they had very large debts to finance their activities. But investors need to be very careful, because the value of assets under a new currency regime can fall very badly, because that new currency regime is going to be a lot more sensible than the old one, you'd hope, which means you won't get the same speculative sort of moves in those asset prices. You won't get the same sort of debt financing. So the way to think about this is that the US housing market was not a great investment for many years after the housing bubble burst, because once a bubble bursts, things tend to get a bit more stable and a bit more normal for a bit of a while. On the first part of Andrew's question, if inflation comes down from the current levels, that has the same impact as an interest rate tightening in real terms. So, for example, in 2008, inflation and interest rates, they were about the same level, and they both went to about zero in various parts of the world. This time, inflation is around about 10% in a lot of the world, while interest rates are about 1% to 2%. Now, if inflation and interest rates both fall to zero again in the coming crisis, then that is the same as central banks raising their interest rates by 7%. Right? Because in real terms, inflation adjusted, that's the real interest rate would actually rise. And we haven't seen that before. We haven't seen a situation where interest rates were so low relative to inflation that in going into a crisis, real interest rates, the interest rate adjusted for inflation, will actually go up. And that's what I think makes the current environment so incredibly dangerous. It's that we're going to feel like the monetary policy is tightening going into a recession, even if interest rates are thrown back to zero.
Yeah, right. That's a really insightful observation.